The economy lost jobs. Wall Street said, "Excellent." America just reported that it lost 23,000 jobs in July. Economists were expecting it to add 80,000. And Wall Street's reaction? Stocks went up. Yes.
The economy lost jobs, and investors basically said, "Wonderful. Buy NVIDIA." Welcome to financial markets. But there is actually a reason, and Fahali is seeing something underneath this rally that the index alone does not show. Here's the simple version. The Federal Reserve has been worried about inflation, and when the economy is strong, the Fed has more freedom to keep interest rates high, or even raise them. But today's jobs report was weak. 23,000 jobs disappeared when Wall Street expected 80,000 new ones.
And it gets worse. The government also revised May and June lower by another 103,000 jobs. So markets immediately started thinking, maybe the Fed cannot afford to make money more expensive. And suddenly, bad jobs became good news for stocks. Because the stock market is apparently the only place where losing your job can occasionally improve everyone's mood.
So unemployment partly improved because fewer people were standing in the unemployment queue. That is like a restaurant announcing, "Great news! Our waiting time has collapsed," because half the customers gave up and went home. Household employment also fell. Retail lost jobs. Financial services lost jobs. Restaurants and bars lost jobs. And wage growth slowed to around 3.2%. This is not an economic disaster, but it is definitely not a strong labor report. As we record this, the S&P 500 is up roughly 0.4%. The Nasdaq 100 is up around 1%. NVIDIA is up about 1.5%. Tesla is up more than 2%. Amazon and Meta are positive. But Google is lower. Microsoft is slightly lower.
So this is a rally. But once again, everybody is not attending the same party. Technology and rate-sensitive assets are doing most of the celebrating. Why? Because Treasury yields fell after the jobs report. The 10-year yield dropped toward 4.64%. The 2-year fell toward 4.19%. Lower yields make expensive growth stocks easier to justify. Basically, every AI company just received a small valuation coupon from the Department of Labor. But then gold did something very interesting. Gold is up roughly 2%, and that matters. Because investors are simultaneously doing two things. They are buying stocks because they think rates may stay lower, and buying gold because they are not completely comfortable with why rates may stay lower. Everything is wonderful, but keep the fire extinguisher nearby. The dollar also weakened after the jobs report, and that is giving additional support to gold and other dollar-sensitive assets. So today's market is not pure risk-on. It is risk-on with insurance. Now, let's talk about oil, because oil has apparently decided the Federal Reserve's life was becoming too easy. Brent crude moved back above roughly $83 a barrel. WTI was around 78, and Fahali's oil read remains tilted upward. The USO oil proxy currently carries a mild upside skew. Fahali's model sees roughly a plus 1.7% expected move, although confidence is only about 54%. So this is not, oil is definitely going higher. It is, oil deserves your attention. And Fahali's order flow engine is detecting an accelerating positive imbalance, equivalent to roughly $298 million. Important. That is an order flow proxy. It is not $298 million of verified institutional buying.